For more on what the Fed's next moves could be, I want to welcome into the program Chicago Fed President Austin Goolsbee. Austin, it is great to see you as always. Thank you so much for joining me.
Yeah, thanks for having me back.
We have had 3 consecutive months of good readings on inflation data as measured by the Consumer Price Index, following 3 months of poor readings in the first quarter. At the same time, looking at the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, that's also showing improvement and expected to show continued improvement for the month of June. So, how confident are you right now that inflation is returning to your 2% target?
Well, it makes me feel a lot better that we've had multiple months in a row of improvement, and that this bump in the road at the beginning of this year looks like a bump, which followed, importantly, 7 straight months of very strong inflation numbers at the end of last year. So if you just kind of look at the through line, it's very clear that inflation's come way down in a 12 to 18 month period. This is about as fast as inflation has ever fallen in the U.S., and we did it without a recession. That's what I call the golden path. It's not done, but it makes me feel a lot better when you both see it for multiple months in a row and you see the components that you're finally starting to see the declines of housing inflation that we've been anticipating, and you're seeing improvement on the services side too.
Assuming we do get progress on the June reading for the Personal Consumption Expenditures Index, which is due out next Friday, would that give you the confidence that you need that inflation is sustainably coming back to 2%, or would you need more than a quarter's worth of good data?
That's a little bit hypothetical. We get a lot of information. There's not just one thing that we look at to try to gauge, or that I look at. I'm not to speak for anyone else on the committee. Those are the rules. So I think the more information we get that shows that the economy does not look like it's overheating, and that we're getting improvement both month after month and in the components on inflation, like what we've now seen for several months in a row, to me, that's what the path to 2% looks like, definitely.
The unemployment rate has ticked up for 2 consecutive months. We now stand at 4.1%, which is low by historical standards, but that's up from 3.4% over the past year. So what signal are you taking from the bump up in the unemployment rate now above 4%? How are you viewing that?
Yeah, I like your characterization that the level is pretty strong, pretty close to what economists consider full employment, what the median SEP dot says is long-term unemployment, and yet directionally, the labor market has been cooling. It's been cooling to a position of better balance, but it has been cooling. And that in itself is not the usual historic norm. It doesn't usually cool mildly. We are either improving or getting worse. So it's definitely an area of concern, one to keep your eye on. There are some other warning lights, I'd say, but so far this doesn't look like a recession. It's just a cooling back to better balance, but it needs to stabilize at that and not keep getting worse.
You just said it's a warning light. Are we approaching an inflection point in the labor market where perhaps if we see further softening in demand for workers, that could result in a bigger and less welcome increase in unemployment?
I hesitate only of what it depends what you mean by inflection point. If we're getting to a steady state position of balance, which is what we want to, then this slow cooling of the labor market to something like the full employment rate, it should stop there. And we want to be stable at a kind of a steady state basis. So for sure, if unemployment continued to deteriorate, or if you saw a sharp uptick in unemployment looking like what happens at the beginning of a normal recession, you would be definitely justified to be agitated about the employment side of the mandate. Thus far, it doesn't look like that. I mean, the levels are still historically, as you pointed out, pretty low, pretty close to what we think of as steady state. but it needs to steady. It can't keep going like that.
So how are you factoring your outlook for the labor market into the path for monetary policy when you're looking to set interest rates?
Well, I think the first thing is the bump up in inflation, in especially January, February timeframe of this year. It was important to take stock. Is that a sign of overheating? And one of the first places you want to look for signs of overheating are broadly defined the job market. I have been saying that the job market didn't really look like traditional overheating. Most of our measures, not just the unemployment rate, but if you take the quit rate, the unemployment to vacancy ratio and the various ways that we measure the labor market, most of those were still cooling and going back to better balance. So I think the job market as an indicator of where we are in the business cycle is one of the important ways. And then the second is, it's right in the law. That's the Fed's mandate: maximize employment and stabilize prices. So we're supposed to be, and we do, look at employment on its own because the law requires us to.
Right. So given the cooling that you're seeing in the labor market, coupled with the fact that inflation is coming down, you're saying that perhaps what we saw in the first quarter was a bump in the road. Do we have the basis right now for a rate cut?
Well, I don't like tying our hands ahead of time when we're going to get a bunch of data before the next meeting, and I like to hear what the views are of the other participants of the FOMC. So I'm not going to say this number says we should do X at the next meeting, but I will say the through line. Yeah, this is what the path to 2% looks like, and you saw in the FOMC statement, voted on by all of us, that we have said the committee would not consider rate cuts until we had more confidence that we were on path back to 2% inflation. And to me,
be clear, you are on the
months
path
like
right
the
now.
ones we've been seeing, that's the path.
So you are on the
say
path
again?
right now, is that right?
I like that path, but as I say, I'm not tying our hands. We're going to get a lot of information before the next couple of meetings.
So then is the case building for a potential rate cut in September, if not in the next couple of weeks at the end of this month?
Well, like I say, I'm not going to say about the timing. The more months you get, like last month, the month before, and even the month before that, the more months of data you get, like the last 7 months of last year, for sure, that's what the path to 2% looks like. And that's the golden path, as I called it, that inflation has come down very rapidly in historic terms without a recession. And that's never really happened before in the U.S. or in almost any of the advanced economies. So let's stick with the program. So far, that's working pretty well on the dual mandate grounds.
To your point, last week you said that when inflation was over 4%, that's when you hiked rates to current levels. Now you said let's call it around 2.5%, implying that we have tightened. So do you risk the golden path if you don't cut soon?
Yes.
So then what does that set us up
You risk the golden. If you're going to be as restrictive as we are now, and if I just look at the real Fed funds rate, the interest rate minus inflation, that's as high as it's been in decades. And when do you want to be that restrictive? As I say, you want to be restrictive if you're afraid of an overheating economy. The economy's not overheating. And we set this rate, as you point out, when inflation was over 4. So in real Fed funds terms, we have tightened pretty substantially. And let's just make decisions about restrictiveness by choice. Let's not back our way into it. That's my view.
So then where are we in this economic cycle? Are we late in this expansion at this point? And do you need to be ahead of the curve, right? When we look at the labor market, we know that peaks after the economy peaks. Do you need to be ahead of that?
Yeah, the question mark is, does this cycle look anything like or how much like previous cycles. So far, there are so many things different about it that it's a little hard to generalize lessons from past business cycles for what we should do right now, or even to figure out, are we in a late inning, a middle inning, an early inning on the cycle. We had a recession that was driven by a collapse of services, which never happens, where durable goods and a bunch of the things that are usually cyclical actually went up during COVID because people couldn't spend their money on other things. We've seen a gradual increase in the unemployment rate. That never happens in a business cycle. It usually goes up like a rocket and down like a feather. And we've seen a major increase in rates, 550 basis points or so, without what you would have expected to be the severe negative consequences on the most interest rate sensitive sectors of the economy. So I think given how unusual the last 4 or 5 years have been, we should be a little circumspect with concluding what the lessons of past business cycles are.
Austin, in order to stay on the golden path this year, ballpark, how many rate cuts do you think are needed?
I don't know. The issue that I will point out, I don't like tying our hands or committing to rate cuts at the next meeting. I definitely
But
do
how
not
many? I'm
like
saying how many, not
deciding
necessarily
things
when.
for 4, 5, 6 meetings from now.
But what about the number, right? Not just when you would do it, but like how many you think? Like one,
That's what it
two?
is. If you give a number, you are saying what you think should happen over the next 6 or 8 meetings, and I decline to do that. I think the way the FOMC works and is structured, we decide meeting by meeting what to do. I don't think that we need to be committing to a path of what we don't know what the conditions are going to be like 6 months from now, so I'm not comfortable committing to numbers of cuts, holds, or increases for multiple meetings in the future.
All right, well, I tried. Austin, thank you so much, as always, for your insight. Really enjoyed the conversation. Look forward to talking to you
It's
soon.
great. It's always fun talking to you.
Thanks so much. That's Chicago Fed President Austin Goolsbee. Shauna, I'll send it back to you in New York.